What if the biggest risk in your portfolio isn't a market crash, but the fact that millions of Americans are unknowingly invested in the exact same AI stocks? Right now, a small group of companies is driving a huge portion of the stock market. And while most investors think they're diversified, the reality may be very different. So before you buy another share, there's one critical question you need to ask yourself. Are you truly diversified? Or are you making the same mistake investors made before previous market corrections? Stay with me, because what you're about to learn could completely change how you look at investing in America today. S&P 500 concentration risk. Too much money is now tied to a few AI stocks. Many Americans believe they own a highly diversified portfolio because they invest in an S&P 500 index fund. On the surface, that sounds true. After all, the S&P 500 includes hundreds of America's largest companies. But here's what many investors don't realize. Today, a very large percentage of the index is concentrated in just a handful of mega-cap technology companies. Companies like Apple, Microsoft, NVIDIA, Amazon, Alphabet, Meta, and Tesla have become so large that they now drive a significant portion of the index's performance. That creates a hidden risk. When these companies rise, investors feel great. But when they struggle, millions of retirement accounts, brokerage accounts, and 401k portfolios can feel the impact at the same time. This is especially important right now because many of these companies are spending billions of dollars on artificial intelligence. AI could absolutely become one of the most important technologies of our generation. But great technology does not automatically guarantee great investment returns. History has taught investors that lesson many times. In the late 1990s, investors rushed into internet-related companies because everyone believed the internet would change the world. They were right. The internet did change the world, but many stocks still crashed because prices moved far ahead of business reality. That is the difference between a great technology and a great investment. Today, AI excitement is pushing enormous amounts of money toward the same group of stocks. That doesn't mean a crash is guaranteed. It simply means investors should understand the risk. The biggest mistake is believing diversification exists when most of your portfolio depends on the same small group of companies. If those companies continue winning, investors benefit. If growth slows, profits disappoint, or market expectations become unrealistic, portfolios heavily tied to those stocks could experience significant volatility. That's why many experienced investors are starting to ask a simple question. Am I truly diversified? Or am I just heavily invested in the AI trade without realizing it? And that question could become one of the most important investing questions Americans ask over the next decade. Now that we understand the risk, the next question becomes, what should investors actually do? First, let's clear up a common misunderstanding. Reducing risk does not mean selling everything. It does not mean predicting a market crash, and it definitely does not mean trying to time the market. The goal is much simpler. Build a portfolio that can survive different future outcomes. Because the truth is, nobody knows exactly what will happen next. AI could create enormous economic growth. Technology stocks could continue climbing for years, or market leadership could shift to completely different sectors and countries. The smartest investors prepare for multiple possibilities instead of betting everything on one outcome. One practical way to do that is by looking beyond only the S&P 500. Many Americans already have most of their investments connected to the U.S. economy through their jobs, homes, businesses, and retirement accounts. Adding exposure to international companies can provide another layer of diversification. There are world-class businesses outside the United States that operate across healthcare, manufacturing, consumer goods, banking, energy, and technology. A diversified global portfolio helps reduce dependence on any single country, industry, or market trend. Another important step is understanding your asset allocation. Many investors focus entirely on returns, Professional investors focus on risk-adjusted returns. Those are not the same thing. For example, a portfolio that grows steadily over decades often beats a portfolio that experiences extreme ups and downs because investors are more likely to stay invested during difficult periods. That's why successful investing is often less about finding the next hot stock and more about creating a system you can stick with. A simple framework many long-term investors follow is core portfolio first. The majority of investments remain inside broadly diversified index funds. Then a smaller percentage can be used for higher risk opportunities, such as individual stocks. This approach allows investors to participate in future innovation without putting their entire financial future on the line.
The key lesson is simple. You don't have to be anti-AI, you don't have to be anti-technology, you just don't want your entire portfolio depending on one story, one sector, or one group of stocks. Because diversification may feel boring during a bull market, but when markets become volatile, diversification often becomes one of the most valuable decisions an investor ever makes. At this point, the most important question is not whether a market crash will happen. The real question is
your portfolio prepared if it does? Most investors spend too much time trying to predict the next headline. Successful investors spend more time preparing for different outcomes. That's a major difference. So what should you do today? Start by reviewing where your money is actually invested. Many Americans are surprised when they discover how much of their portfolio is indirectly tied to the same handful of large technology companies. Your 401k, IRA, brokerage account, and index funds may all contain significant exposure to the exact same stocks. That creates more concentration risk than many people realize. The first step is awareness. Know what you own. The second step is diversification. Ask yourself, if one sector struggles for several years, can my portfolio still succeed? If the answer is no, you may need broader exposure across industries, company sizes, and global markets. The third step is controlling emotions. Every market cycle creates fear and excitement. During bull markets, investors believe prices will rise forever. During bear markets, investors believe prices will never recover. History shows both assumptions are usually wrong. The investors who build wealth over decades are often the ones who remain disciplined when everyone else becomes emotional. That means avoiding panic selling. It means continuing to invest consistently. And it means focusing on long-term ownership instead of short-term predictions. Remember, the biggest threat to most investors is not a market crash. The biggest threat is making emotional decisions during a market crash. That's where fortunes are often lost. The investors who succeed are usually not the smartest people in the room. They're the people with the strongest process. As we look ahead, AI will likely create winners and losers. Some companies will justify today's expectations, others won't. No one can know in advance exactly which companies will dominate the next decade. That's why betting everything on a small group of stocks can be dangerous. Instead, focus on building a portfolio designed to benefit from long-term economic growth, wherever it comes from. Because investing is not about being right every year.
It's about staying in the game long enough to let compounding work. And that brings us to the most important lesson from today's discussion.
Don't build a portfolio that only works if one prediction comes true. Build a portfolio that can succeed even when your prediction is wrong. That's how risk is managed. That's how wealth is built. And that's why many experienced American investors are quietly reviewing where their money is invested before the next major market downturn arrives.
If you want to change your financial future, subscribe to our channel, like the video, and comment below with your next goal.